For decades, the standard path to building wealth in Nepal was simple. You parked your surplus cash in a commercial bank fixed deposit and collected guaranteed returns that often exceeded 11%. But over the last 2 years, that yield vanished. The weighted average fixed deposit rate across commercial banks fell to 3.35%. While banks pay 3%, consumer price inflation is running at 5.04%. Rising costs are moving faster than your savings. That average inflation rate hides much steeper spikes in daily costs. In the last year, transportation expenses rose 12%, and miscellaneous goods and services increased by nearly 20%. This burning 1,000 rupee note inside a savings jar illustrates the current reality for Nepalese depositors. Your money is losing value because the bank interest fails to cover the rising cost of living. We can calculate the exact rate of that erosion. Subtracting the 5.04% inflation rate from your 3.35% bank return leaves a negative real yield of 1.69%. For every 10 lakh rupees in a fixed deposit, you effectively lose 16,900 rupees in purchasing power. This raises a specific question about the banking sector. Why are institutions accepting massive amounts of capital while offering returns that result in a loss for the depositor? The negative yield ultimately reflects a massive structural imbalance in exactly how capital currently moves and pools throughout Nepal's entire financial system. To understand this liquidity, look toward the global labor market, where the Nepalese diaspora is generating a massive influx of capital. This map shows the flight paths of that capital. In the last reporting cycle, foreign remittances surged by 39.1%, totaling over 1.65 trillion rupees. Consequently, gross foreign exchange reserves reached $24.19 billion, causing total banking system deposits to grow by 16% year over year. When foreign currency enters the system at this scale, the domestic banking sector struggles to manage the resulting liquidity imbalance. The bar chart explains why interest rates dropped. While deposits rose by 16%, credit to the private sector grew by only 5.7%. Banks are hesitant to lend because non-performing loans have reached 5.4%. Low business confidence has effectively slowed the outflow of bank capital. Stuck with trillions in unlent cash, banks slashed deposit rates to protect their profit margins. Faced with these rates, capital is leaving traditional accounts. These green arrows trace money moving from vaults into land, gold, and the stock market. This migration is fueled by low borrowing costs. Commercial bank share loan rates have dropped to 6.73%, encouraging a move into speculative assets. Follow the pipeline on the right. This cheap credit flows directly into low-cap NEPSI sectors, driving up hydropower and microfinance valuations. This liquidity bottleneck has a clear impact. Savers are shifting into higher-risk categories to try and outpace inflation. Protecting your wealth in this environment requires shifting from passive holding to active capital management. Looking at Shield 2 in the center, professional managers suggest moving surplus cash into corporate debentures or treasury bills, yielding 6 to 9%. To the left, Shield 1 highlights fundamental blue-chip stocks, offering dividend yields that can match or exceed 5% inflation. How are you adjusting your own portfolio? Are you sticking with fixed deposits or moving into the NEPSI, real estate, or business expansion? Please let us know by commenting 1, 2, 3, or 4 below. In 2026 Nepal, maintaining a large cash balance in a savings account results in a predictable erosion of wealth. Subscribe to the Himalayan Investor for more data-driven updates, and I'll see you in the next video.